The budget is coming up on the 22nd. It's one of the big event risks that SA is facing in February. The way that I've seen February as a month is we're getting various pieces of a puzzle. We had the SONA, in which it was announced that the electricity will be moved into the presidency, which is important because we need to know whether it's going to fall under DMRE or not. And falling into the presidency, I think will mean that it is quite independent of a lot of the political noise. That was the first piece of the puzzle. In that SONA, we also learned that the social relief of distress grant, the SRD, will be extended. So we need to look at the budget to see if that's going to be an expenditure overrun, which I don't think it will be. As far as I can see, that's been provided for the next 2 years. And then we're going to get the cabinet reshuffle, which will be another source of event risk, followed by our grey listing decision on the 24th of February. So these will paint a picture of the year that South Africa is going to face. I think a lot of investors are waiting for this month to be over before investing in SA bonds, specifically offshore investors. We are seeing funds returning to emerging market funds globally, and South Africa should see some of that money flowing in after the event risks that we face this month. In the budget, what we notice when we analyze the budget is even with the lower growth rate, and I've factored in a growth rate of 0.6% for this year, we need to bear in mind that the Reserve Bank is factoring in 0.3%. So there are, I think, definite risks to that 0.6%. And it depends on how long load shedding continues for. But 0.6% growth still gives us a surplus on the primary account of 0.7%. Now that is excluding any bailouts to SOEs, including Eskom. And in the following year, that surplus increases to 1.7%. This is important because what we're seeing here is that Treasury and government made a concerted effort 10 years ago to move SOEs off National Treasury's balance sheet and corporatize those entities. What we've seen is that has not been successful, and the balance sheet risk of the SOEs has slowly come back onto National Treasury's balance sheet. And we're waiting to see if the entire debt of Eskom will be taken onto Eskom's balance sheet. The latest amount of that debt as at December 2022 is 422 billion. Now, as far as I can see, when you look at National Treasury's redemption profile, that means the debt that we have to pay back. We've been paying back 44 billion per year since 2016, 2017. That's been our average debt repayments. Not the debt service cost, but the actual debt repayments. We are going into an environment over the next 8 years where we're going to have to pay back 200 billion on average per year. That is going to, that's an environment I don't think we quite know how to deal with or how it's going to impact National Treasury. And for them to take on an additional 422 billion of Eskom debt in one go would, I think, be very detrimental to our bond yields. The kind of issuance you'd have to issue so much more debt that your bond yields would increase dramatically, and that would increase your cost of debt and reduce the amount of money that you have for things like social grants, etc., which would cause social unrest. So that's, I would think, not an option. But you do need National Treasury to come out with a detailed framework of what they're going to do about the Eskom debt. I think at this point we need to also bear in mind that electricity has become a political imperative for the ANC, and it's going to determine how well the ANC does in the 2024 elections. But it's not so much the debt relief that will determine that. It's more load shedding. And if we go into stage 4 load shedding for the rest of the year, I think that will be politically quite unpalatable. So our budgets should have allocation to assist with load shedding and the costs that come with load shedding. Part of that will be diesel costs. And that could be anywhere, I would say, between 17 billion, which has been the stated, one of the stated costs. I think the risk to that is it could be higher. So we could face additional diesel costs. And that, I think, we need to factor into our expenditure. I think there's wage risks, although those aren't, I think actually Treasury's covered a lot of those wage risks. If you look at a detailed breakdown of their various costs. But I do think, when you look at wage negotiations, we shouldn't count on only a 3.1% increase in wages, which is what has been budgeted for. So there is risk there on the wage front. Yeah, so overall, the big story for this budget is unfortunately going to be Eskom. And I say unfortunately because there's no quick fix for Eskom. It's something that is going to take a lot of time and is incredibly complex and political. So it's not just, it's definitely not a Treasury story. And I think from Treasury, what we need to see is that they protect the sovereign balance sheet as much as they can, because I think for them that is their key priority.